Ladies and gentlemen, good afternoon or good morning, and welcome to this DBRS Morningstar webinar on performance and prospects for Italian banks. My name is Nicola De Caro. I'm Senior Vice President of the banking team in Frankfurt. And today I'm joined by my colleagues Andrea Costanzo and Arnaud Journois from the Financial Institution Group and Carlo Capuano from the Sovereign team. This webinar is expected to last approximately 40-45 minutes. There will be a presentation with slides followed by a Q&A session. If you want to ask questions, please use the question mark box on the right-hand side of the screen. Let me start with a very brief summary of some of the key aspects that will be covered in this webinar at page 2. Well, DBRS Morningstar rating outlook for Italian banks is generally stable. So in our view, banks rating are well positioned in the current economic environment. And the negative trends that we assigned during the pandemic have reverted to stable during 2021 and 2022. Some key consideration here. First of all, Italy post-pandemic recovery, which has been stronger than major Eurozone economies such as Germany, France, and Spain. And despite the ongoing economic slowdown, the job market is expected to remain resilient. Bank profitability is improving thanks to a combination of higher net interest income and lower underlying loan loss provisions. Asset quality has improved substantially. However, a modest deterioration is expected, taking into account a more challenging economic environment with high inflation, rising borrowing costs, economic slowdown, and a geopolitical risk. Funding and liquidity conditions remain adequate, but refinancing costs have increased. While bank solid capital position is underpinned by improved profitability and solid buffer. With that, let me hand over to Carlo Capuano from Sovereign. He will provide an overview of the operating environment in Italy. Carlo, please go ahead.
Thank you, Nicola. Let me start with a positive message. So here at slide number 4, if we look at the chart on the left, we see that Italy's post-pandemic economic performance has been remarkable so far. The real GDP level at the end of 2022 is almost 2 percentage points higher than what it was in the last quarter of 2019. And despite the large fall in the GDP level due to the initial shock of the pandemic, the real GDP level now is slightly higher also than France and Germany. In our view, this development reflects the resilience of the manufacturing sector, but also the exceptional performance of the construction sector. In gross value added terms, the construction sector expanded more than 25%, benefiting particularly from government incentives. Before moving to 2023, please let me say a couple of words regarding Italy's economic performance in 2022. It was solid, with GDP estimated to have expanded by 3.9%. And this was supported particularly by strong domestic demand in the first half of the year. Nevertheless, the significant increase in the energy prices during the second half of 2022 led to a sharp slowdown in consumption and investment during rising interest rates. This contributed to a contraction in the GDP of 0.1 quarter on quarter in the last quarter of 2022. Moving to 2023, and so if we look at the chart on the right, we see the forecasts of Bank of Italy, European Commission, the Ministry of Finance, and IMF, starting from what they were thinking in January 2022 of Italy's performance in 2023. At that time, they were expecting a growth rate for 2023 of around 2.1, 2.5%. But then after the invasion of Ukraine, they have revised down the projection But over the last few months, we have seen an improvement reflecting the expectation of lower inflation in 2023 due to a moderation of energy prices. And if we look at the latest estimate of the European Commission, the growth rate is expected to be 0.8%, so slightly lower than the Eurozone average. And this should reflect a gradual resumption in consumption, in particular in the second half of the year, but also the support of the public investment under the Recovery and Resilience Plan. On the other hand, we have to highlight that probably the performance of the construction sector will be affected by the current decision of the government to stop the sale and the transfer of the tax credit due to housing incentives. So we have to see how will be the performance of the construction sector. However, it should continue to benefit from construction works that have been already started, but also the public investment under the Recovery and Resilience Plan. Moving to slide number 5. So here I think it's important to highlight how the job market is performing. Despite the pandemic, we have seen very resilient labor market. The employment rate is above pre-crisis levels, and the unemployment rate also is at a low level, 7.8%, similar to what it was pre-global financial crisis. The expectation is that despite the economic slowdown, the labor market is expected to remain resilient. Latest projection from the Central Bank of Italy point to an average unemployment rate of 8.2%. Moving to inflation, here there is a little bit of uncertainty regarding the level, how inflation will go down this year. If you see from the chart on the right, headline inflation in blue peaked at the end of 2022 and now is falling. And the expectation is that will continue to decline due to the negative base effect of the energy component. However, there is a bit of uncertainty regarding the core inflation that you see here in red, which could be a little bit more, could be stickier, and due to higher prices for services. Latest estimate from the central bank, in any case, point to a fall in the inflation, average inflation, from 8.7% in 2022 to 6.5%. So the overall message here are that the economic performance of Italy so far has been better than expected, better than Germany and France. There is a bit of for 2022 we expect economic growth slightly lower than the eurozone. At the same time, the labor market is expected to be resilient despite the economic slowdown. There is a bit of uncertainty on inflation, but also inflation is expected to go down. With that, Nicola, I will hand over to you.
Thank you, Carlo. Very interesting. Okay, so the following section will cover banks' revenues. Page 7. This page shows the quarterly evolution of profits before, during, and after the pandemic. For the purpose of this analysis, we have aggregated the data for 5 large banking groups. However, many of the trends that will be covered in this presentation are applicable to the rest of the banking sector. The headline is that 2022 was a positive year for the sector. Some banks reported record results or the best results since Lehman. In general, results benefited from higher revenues, flattish operating expenses, and lower underlying credit costs. To give you some numbers, for full year 2022, the total net income was around 13 billion, up 66% year on year, or up by 80% when excluding certain charges, such as those for Russia. On a quarterly basis, net profit was around 4 billion in Q4 2022. Take a look at the green bar, which compares with an aggregate net loss of 1 billion in Q4 2021, as shown in yellow. The red bar shows the performance in 2020, which incorporated the negative effect from COVID, both in terms of revenues and provision, particularly in Q1 and Q4. Slide 8. Improvements in revenues was a key driver of profitability in 2022, particularly in the second half, as can be observed in the chart on the left-hand side. Core revenues, being a combination of net interest income and net fees, were up by 21% year-on-year and up 18% quarter-on-quarter in Q4 2022. For full year 2022, total revenues were up by 8% year-on-year. After a long period of ultra-low interest rates and weak performance, NII, which remains the main contributor to bank revenues, has seen a double-digit growth in 2022. Particularly in Q4, aggregate NII was up by roughly 50% year-on-year or 30% quarter-on-quarter, as a result of higher interest rates and asset repricing, as shown in the chart on the right-hand side. On the other hand, net fees were down 2% year-on-year for full year 2022 as a result of weaker market conditions. Moving to page 9. In our view, Italian banks remain well positioned to benefit from the current interest rate environment, given the large proportion of exposure to floating loans. The charts show the share of variable rate loans for house mortgages based on new business volume and the comparison with other markets. In this particular case, Italy is highlighted in gray. Moving to page 10, on this page you can observe the evolution of the various components in NII. The blue line shows interest rates on loans. The red one shows the interest on term deposits, while the yellow line represents the cost for current accounts. As you can see, interest margins widened in 2022 as loans have repriced faster than deposits in the current environment. Following page, just a couple of comments about volumes, lending volumes. And as you can see, in this environment, volume growth has slowed down for both household and corporates, but this is particularly evident on the corporate side. Before we move on to asset quality and efficiency, I would like to spend a couple of words on expectation for NII and revenues. In general, in our view, prospects for revenues and profitability remain positive for the current year. However, the growth in revenues will probably accelerate at some point. We expect indeed that the repricing of deposits, higher funding costs on the wholesale market, weaker loan demand, and more competition between banks to absorb part of the upside we were talking about before. In addition, we remain cautious about potential side effects from rising interest rates. A significant further increase in interest rates and a material deterioration of the economy could create some asset quality problems in the future. These are some of the key factors that we will continue to monitor in the coming quarters. And with that, I hand over to my colleague Andrea for asset quality and efficiency. Andrea, the floor is yours.
Thank you, Nicola. So let's focus on operating efficiency on page 13. Cost control remained adequate in 2022 with flattish operating costs year over year, despite some inflationary pressure. However, the average cost-to-income ratio was down around 4 percentage points year over year to 57% in full year 2022, driven by higher revenues. You see a peak of 68% in the cost-to-income ratio in Q4 2021, but that quarter incorporated a higher cost base from M&A transactions, as well as resulting integration and optimization expenses. We've seen Italian banks making significant efforts on restructuring in recent years. In our view, cost optimization measures will remain key to address high inflation, higher energy bills, and digital investments going forward. Jumping to the next slide. So this slide on the left-hand side shows the quarterly evolution of loan loss provisions from 2019 to 2022. In Q4 2022, loan loss provisions were down 13% year over year, reflecting stronger risk profiles. However, they were more than 2 times higher compared to the previous quarter, mainly due to seasonality, the update of internal model assumptions driven by an expected slowdown in the economy, and finally, a front-loaded impact for future de-risking. As you can see in the chart on the right-hand side, data in 2022 also incorporated sizable provisions for banks' direct exposures to Russia and Ukraine, which have reduced quarter by quarter. Overall, loan loss provisions were up 5% year over year in full year 2022. However, they were down 30% when excluding provisions for Russia. The reduction in credit costs is even more evident when comparing 2022 with 2020, which was affected by provisions for COVID. Moving on to the next slide. So notwithstanding the impact from Russia and Ukraine that we have just seen in the previous slide, the average cost of risk in full year 2022 was 58 basis points, which is below the levels reported in previous years. For the time being, banks are guiding for a further reduction in cost of risk in 2023 to an average level of 45 basis points, as they expect provisions for Russia and Ukraine and for future de-risking to decrease. Nonetheless, in our view, cost of risk could increase in coming quarters should the economy slow down more than expected and default rates deviate materially from current levels. It is worth mentioning that banks can still leverage on the overlay provisions booked due to COVID-19, which have only partly been released to date. On top of that, we know that some banks also added new overlays in 2022 to cope with higher risks on more vulnerable exposures in the current environment. Let's turn to page 16. So, new non-performing loan formation did not show any material increase in 2022, so the average default rate was just around 1% in the year. And overall, default rates for households, firms, and the total economy remained much lower than the peak levels reported 10-15 years ago during the global financial crisis. The support measures implemented during the COVID-19 pandemic, such as debt moratoriums and state-guaranteed loans, coupled with a higher than expected recovery in the economy, have limited asset quality deterioration in recent years. Nevertheless, we expect default rates to increase in coming quarters, as higher cost of living, higher interest rates, and the likely slowdown in economic activity continue to affect households' disposable income and corporates' cost structures. Moving on to the next slide. So as you can see on this page, asset quality metrics have improved further in Q4 2022, driven by a manageable level of new NPE inflows, continued organic workout, NPE disposals, and sound new loan generation. As of end 2022, the average gross NPE ratio was 3.3%, and the net NPE ratio was 1.7%. These levels are now more in line with the European average. The cumulated reduction in the aggregate stock of gross NPEs reached 60% since end 2019, which is a testament to the significant progress achieved in the de-risking balance sheets. The de-risking process has been also facilitated by the usage of the so-called GAC scheme, which provided for the state guarantee on non-performing loan securitizations. The GAC scheme expired last year, but our understanding is that it could be renewed, although at less advantageous conditions for banks. Overall, Italian banks are definitely entering this phase of renewed uncertainty with a much better risk profile than in previous adverse economic cycles. Let's turn to page 18. On this slide, we wanted to show the evolution of stage 2 loans, which are loans where credit risk has increased since origination. As you can see, stage 2 loans have increased in recent years, and this reflects a number of elements. In 2020, COVID-19 triggered the reclassification of a significant portion of exposures to stage 2 in anticipation of a likely deterioration in asset quality. The stock continued to increase in the following years, although at a slower pace, reflecting inflows attributable to banks' direct exposures to Russia and Ukraine, and more generally, exposures to more vulnerable sectors in the current environment, such as energy. This has been only partly offset by migrations back to stage 1 as the economy bounced back and outflows due to the ongoing reduction in banks' direct exposures to Russia. Overall, stage 2 loans represent around 10% of total loans, slightly above pre-COVID levels. Similarly, coverage on stage 2 loans has increased slightly in the same period. And we expect some of the stage 2 loans to migrate to stage 3 as default rates start to increase. And with that, I hand over to Arnaud for some considerations on funding and liquidity and capital.
Thank you, Andrea. So we can now go to slide 20, where you can see on the right that after a peak in 2014, Italian bank sovereign bond holdings have reduced. That said, the proportion still remains sizable at around 9% of total assets, and this is because Italian banks have taken advantage of opportunities for gains due to lower spreads. However, if we take a look back, amidst higher sovereign spreads back in 2018, banks took steps to protect their capital base against volatility by shifting the vast majority of their exposures to amortized costs from at fair value. And this is evident on the chart on the right, where you can see that 64% of Italian banks' exposure is now at amortized costs. Of course, we view this as positive because this limits fluctuations to changes in interest rates and sovereign spreads. On top of that, we expect the recent reduction in the Italian sovereign spread to benefit capital ratios overall, as part of the negative valuation of the sovereign portfolio is being offset. On the next slide, you can see that despite early repayments triggered by the recent ECB change in terms of conditions of the TLTRO III program, Italian banks actually remain the major user of Eurosystem funds. You can also see that Italian banks have between early November 2022 and end 2022 repaid 17% of TLTRO III funds, which is sizable. Despite this, it is still a lesser proportion than the European banks average, as the cost of TLTRO III for Italian banks still remains more advantageous than current market rates. On the right side, you can see that Italian banks are largely funded by deposits raised from individuals and enterprises. But in Q3 2022, you can also note that TLTRO III still accounted for 16.5% of Italian banks' total funding. The program, however, will expire in 2024, but the bulk is expecting to fall due in June 2023. On the next slide, we expect TLTRO III repayments will be manageable because Italian banks benefit from high liquidity ratios, as you can see on the chart on the left. Here, we also note that less significant banks typically report higher liquidity ratios, and this is because they are more likely to keep TLTRO III funds until maturity, given the potential challenge for them to raise funding at an attractive cost following the recent increase in interest rates. We also expect refinancing costs to increase as this funding source will be replaced at higher interest rates. However, this is in our view manageable, as we only expect a portion of this to be replaced, since TLTRO III was mostly redeposited back at the European Central Bank for carry trade purposes. This is actually illustrated on the right-hand side, where you can see that the excess liquidity represented in early November 2022 around 75% of TLTRO III funding.
On top of that, because of the current economic environment, we anticipate a slowdown in loan demand and supply. With loan growth decelerating, we therefore expect lower funding needs for Italian banks. Finally, as you can see, Italian banks' capital ratios have gradually increased, and this was driven by two effects: continued de-risking and higher internal capital generation. You can also note that Pillar 2 requirements increased, but despite this, we still consider banks report robust buffers over regulatory minima, which leave them well equipped, in our view, to face upcoming challenges. This, coupled with improved expectations for future internal capital generation, have even led banks to revise upwards their guidance for dividend distribution in 2023. Well, that concludes our presentation. Back to you, Nicola, for the Q&A session.
Thank you, Arnaud. And let's open the Q&A. As a reminder, please use the question mark box on the right-hand side of the screen if you want to ask questions. So we got one question on asset quality for Andrea. Andrea, do you see a risk that NPLs might reach the level seen in the previous crisis?
Interesting question, thank you. So I would say we definitely expect NPL inflows to increase in the coming quarters, given the economic slowdown. However, as pointed out at the beginning of the presentation by Carlo, we've seen that the Italian economy is actually performing better than expectations, and the latest projections for GDP growth and labor market are now less pessimistic for 2023. So this suggests that a severe recession is unlikely, and therefore, at this stage, we do not anticipate NPLs to reach the level seen in the previous crisis. Let me spend a few words on Italian banks' asset quality and capital. So definitely, Italian banks are entering this period of uncertainty with a stronger risk and capitalization profile, as we have seen during the presentation. Several banks have already exceeded their NPL targets, yet the risking should continue going forward, and this will contribute to absorb part of the new NPL inflows. Also, we believe that the banking sector has built expertise in managing NPLs and improved the risk management and workout process. Furthermore, I would say the NPL primary and secondary markets have also proved to be quite dynamic in recent years. In addition, a system-wide NPL coverage level of around 50%, as well as higher coverage level on performing loans, which recently benefited from the overlay provisions booked over the last years. Certainly, these elements provide a cushion against future risks for asset quality. Let me just conclude with a few words on capital. So clearly, banks have strengthened capital positions and built solid buffers. So the average CET1 ratio, as we have seen during the presentation, is now at around 15%. And this, in our view, ensures banks with adequate cushion over regulatory minimum requirements. Back to you, Nicola.
Thank you, Andrea. Question on funding for you, Arnaud. In your view, by which funding source TLTRO III funding will be replaced?
Yes, thank you, Nicola. First of all, I would say that the end of TLTRO III does not mean the end of ECB funding. We still expect banks to access ECB through secured funding sources, such as repos, for instance. However, what we are sure of is that it will not be at the same condition as before. Also, I would say we do not expect banks to replace the entire TLTRO. At the same time, we expect banks, of course, to continue issuing on the wholesale market for MREL purposes. There are requirements that they need to comply with. But overall, I would say we expect refinancing costs to increase also for depositors. Back to you, Nicola.
Thank you. Another question on risk for Andrea. Do you see any significant risk from bank exposure to Russia?
Thank you. So let me say, as far as Italian banks' direct exposure to Russia are concerned, we actually know that these are mostly concentrated in the two largest banking groups, Intesa Sanpaolo and the UniCredit. And these exposures have been significantly reduced since the onset of the invasion. So based on the latest information published, we see that at the end of 2022, the exposure through local subsidiaries in Russia was down 40-50% on average. And similarly, the cross-border exposures with Russian residents and counterparties through European subsidiaries were down 65-70%. That said, in our view, the remaining exposure is not material, and any future negative impact should remain broadly manageable. Back to you, Nicola.
Thanks, Andrea. A question, I believe, for Arnaud, which I believe was also partially addressed in the first question. So, Arnaud, do you think there is sufficient capital flexibility should the economic environment deteriorate further?
Yes, thank you, Nicola. So, well, we've seen some banks increasing their distribution to shareholders. So it was either in the form of cash dividends or share buybacks. So, of course, if that happened, and to the same extent, we would expect Italian banks to adjust downwards their payout ratio should the economic environment deteriorate significantly. That we have seen that in the past, and this is something we could also see now. Back to you, Nicola.
Another question for you, Arnaud, which is linked to the previous one. So what are your expectations about cash distribution to shareholders? Do you think Italian banks will increase dividends?
So, I think I personally answered that previously, but let me maybe expand a bit. I would say that, with good results or results that are deemed decent enough, we could expect cash distribution to increase. So this has been seen in other banking sectors as well, but we could expect that for Italian banks as well. I think some announcements have already been done at some banks, so they will increase either through share buybacks, which is one of the options, but the other option, of course, remains cash dividends. Back to you.
Thank you. I've got one question for Carlo. Carlo, how do you see Italy's sovereign rating in 2023?
Well, we confirmed Italy's rating a BBB high with a stable trend in October last year. And that reflects our view that Italy's government continues to implement a prudent fiscal strategy, while the progress in diversifying gas supply should mitigate any structural implication to economic growth. At the same time, we expected the successful implementation of the Italy's recovery and resilience plan to support Italy's growth, in particular with investment and reforms. So according to the calendar, we will publish the review at the end of April, in particular on the 28th of April. For sure, we will obviously monitor the public finance dynamics and Italy's economic performance and the impact on the public debt to GDP ratio This would likely depend on a series of factors, the evolution of the energy crisis, whether the government will extend additional support to shield households and firms from the energy prices, what will be the management of the government, the decision of the government regarding also the impact of the likely inclusion of the tax credit on the public finance accounts from Eurostat, and at the same time also the ECB monetary policy stance, how this will affect also the cost of funding. I would say that if we focus our attention on the debt to GDP ratio, I think we have to start from the fact that there was a sharp decline of the debt to GDP ratio of 10 percentage points from 155% at the peak in 2020 to around 146% at the end of 2022. So the evolution of the debt to GDP ratio probably will continue to depend on the positive differential between the nominal growth and interest cost in a context of prudent fiscal policy. Regarding the nominal growth, as I said before, it's important the dynamics also of the inflation. So there is a bit of uncertainty, but nominal growth is also important that in order to continue to have a positive impact in terms of debt to GDP reduction. For this reason, we think it's also critical that there is commitment in the reforms. We have seen that also the government submitted a third payment request regarding the recovery, the milestones that were and the targets that were achieved under the recovery plan at the end of December. So I think these are all the elements that we will consider in our analysis. Back to you, Nicola.
Thank you, Carlos. Well, it looks like there are no more questions, and so we are coming to the end. We hope you found this discussion useful. For future updates and material, please take a look at our website. And for future clarification or question about these slides, please feel free to reach us via email. Many thanks again for your participation and have a good day. Goodbye.